If you're tired of hearing high risk equals high reward from every finance bro on the internet, you're in the right place. Because today we're diving into the quieter corner of the money world. The side that doesn't scream Lamborghini or private jets, but instead whispers, "I sleep well at night." Welcome to Low Risk Investments in 2025, where slow and steady still wins the race. And nobody is panicking at 2 a.m. because the stock market dipped 0.3%. This is opinion, and if you're looking to grow your money without risking your sanity, keep watching. First, let's get something out of the way. Low risk doesn't mean no risk. There's no such thing as a zero-risk investment unless your grandma's cookie jar counts. Even your savings account is technically an investment, and inflation is the quiet thief breaking into it every year. That said, low-risk options are designed to protect your principal while offering modest returns, not fireworks. But hey, stability is underrated. So let's break down your 2025 options, plain and simple. Let's start with the granddaddy of low risk, high-yield savings accounts. I know, thrilling, right? But in 2025, these are offering surprisingly decent interest rates. After years of central banks doing their thing, you can now find reputable online banks offering between 4 to 5% APY. That's better than letting your money rot in a checking account, earning 0.000 something. The risk, practically none as long as it's FDIC insured. The loss? Just the opportunity cost of not investing elsewhere, but the profit? Slow, steady, liquid, and peaceful. It's like the financial version of chamomile tea. Next up, certificates of deposit or CDs, not the kind that plays music, though those might actually be worth something now. In 2025, CDs have become trendy again. Why? Because locking your money up for 6 to 12 months can now earn you around 5% interest, depending on the bank and term. The risk here is time. Your money's not easily accessible, and if you try to break up with your CD early, you'll pay a penalty. But if you've got cash you don't need immediately, it's a pretty chill ride. Loss? Minimal. Profit? Predictable. Just set it, forget it, and maybe don't stare at it every day like a needy houseplant. Now let's spice things up a bit with Treasury bonds and T-bills. Uncle Sam might not be the most exciting investment partner, but he's historically reliable unless something truly apocalyptic happens. In 2025, short-term Treasury bills are yielding north of 5%, depending on duration. And guess what? They're backed by the US government, which is about as low risk as it gets. The only real risk is interest rate changes and inflation. But if you're not locking in for a decade, you're golden. Profit? Decent. Loss? Very unlikely. Unless the government defaults. And if that happens, let's be honest, we all have bigger problems. On the digital frontier, money market funds are still holding their own. Not to be confused with money market accounts, similar name, different game. These are mutual funds that invest in highly liquid short-term instruments. In plain English, they're basically very boring funds that try very hard not to lose your money. Think of them like the dad genes of investing, unsexy but dependable. They won't make you rich, but they also won't give you ulcers. Alright, let's talk about dividend stocks. Yes, stocks. But not the kind your cousin buys because he heard a TikTok guy say it's gonna moon. We're talking about stable, blue-chip companies, think Coca-Cola, Johnson & Johnson, Procter & Gamble. These giants pay regular dividends, even when the market wobbles. The risk is technically higher than a savings account, but if you focus on companies with a decades-long track record of paying dividends, you're not exactly rolling the dice. You're just politely flipping a coin. Profit? 2 to 5% in dividends, plus potential appreciation. Loss? Manageable, especially if you diversify and avoid emotional investing. Now here's one that often gets overlooked. Bond ETF. These are exchange-traded funds that hold various bonds, from government to corporate. They're great for diversifying your low-risk portion while maintaining liquidity. Unlike buying a single bond and holding it for 20 years, ETFs let you buy and sell like stocks. It's like getting the benefits of bonds without needing to fully commit. The risk? Slightly higher than individual treasury bonds due to market fluctuation, but manageable. Profit? Usually 3 to 5%, depending on the fund and strategy. It's like investing with a seatbelt on. A new trend in 2025? Tokenized bonds and stable yield protocols in crypto? Now hear me out. We're not talking about wild meme coins or crypto casino games. We're talking about blockchain-based bonds backed by real-world assets, offering stable returns and transparency. Of course, this space comes with more risk-smart contract issues. Regulation uncertainty, but it's evolving fast and could offer yields higher than traditional fixed income investments. Just don't put in more than you're willing to lose. Think of it like dipping your toe into the future, not cannonballing into it. Let's not forget REITs, real estate investment trusts. If you want exposure to real estate without becoming a landlord, this is your ticket. In 2025, REITs focusing on logistics, data centers, and healthcare are performing well, and many pay dividends north of 4%. The market can still be volatile, but you're investing in physical assets, not hype. Just watch out for rising interest rates. They can affect REIT performance. Loss? Possible, short-term. Profit? Consistent, long-term. It's real estate without broken toilets. Win-win. And finally, for those who want something as close to zero drama as possible, robo-advisors with conservative portfolios. These digital platforms automatically invest your money based on your risk tolerance. Choose a conservative plan and it'll mix bonds, ETF, maybe a few stocks, and keep you balanced. Great for beginners, even better for people who don't want to check their investments, like they're refreshing their dating app. Profit? Modest. Loss? Managed. Risk? Minimal, especially over time. Now, let's wrap this up with some hard truth. Low risk doesn't mean low effort. You still need to do your homework, stay consistent, and manage your expectations. Don't expect a yacht. Expect a reliable Honda Civic that gets you where you need to go, on time, every time. And honestly, in a world obsessed with instant gratification, that's kind of revolutionary. So whether you're 21 and saving your first paycheck or 45 and tired of the crypto roller coaster, low-risk investing in 2025 is smarter, more accessible, and more profitable than ever, if done right. Diversify, stay liquid, and don't get greedy. That's the recipe. This is opinion, and if you found value in this breakdown, consider subscribing. Not because we told you to, but because your future self will thank you. And probably because we just saved you from putting all your money into alpaca farms or whatever the next trend is. See you in the next one.